if we leave that aside, that was an old-fashioned mistake that those 3 or 4 failed banks from last year in the US made. They got the liquidity risk wrong. They didn't address what today we call Pillar 2 liquidity here in the UK, but it's not a new type of risk.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of treasury, liquidity and risk. Join us as we power up the liquidity conversation.
Hello and welcome to our latest instalment of Liquidity Talks, live stream and podcast. I'm Neville Roberts, CEO and founder of Planix, the market-leading fintech focused on treasury, liquidity and risk. Now, our topic today is entitled Mastering Liquidity Risk in Banking. Welcome to all our audience today. Morning, good afternoon and evening, wherever you may be. Anyone in the audience can ask a question whenever you want to. If you just add it into the comment section you see, hopefully on the right-hand side of your screen, I will take these as we go. Or if any come in at the end, we can ask them to Moorad afterwards. Now, we have a record attendance today, and I think the reason behind that is actually our guest speaker. I'm delighted to be joined today by Professor Moorad Choudhry. Moorad, would you like to introduce yourself, tell us who you are and what you do?
Yeah, you're very kind. First of all, thank you, Mr. Roberts. Moorad Choudhry, you just introduced me. I appreciate the kind words. So what do I do at the moment? Well, I'm a non-executive director at a couple of UK FIs, financial institutions. I always do the odd bit of training and teaching every now and again. But that's no longer full-time. You know, it's one is a non-exec, one is part-time, almost semi-retired. No, I shouldn't say that. Hence, I've got time to enter into these interesting chats with the likes of yourself, Neville. My pleasure to be here. Thank you for the invitation.
No, that's great. I'm just wondering why everyone I know seems to be semi-retired or retiring. I need to get on that bandwagon.
It's your age. Well, yes, one does. It's your age. You just know people. Let's say, I mean, I'm getting on myself. You know, I'll be the big 6-0 in a couple of years. So
I've got too many customer commitments out there. But let's move on now. Moorad, I normally talk at the start of these podcasts a little bit for a minute or two about football, and I'm sure the audience doesn't want us to drone on about England's magnificent victory in the semi-finals of the Euros and everything else connected to that. But what I do know, because I was told this, that your team brought my team, which is this one, Liverpool, our biggest heartache probably ever, but at least in the last 35 years. Would you like to explain a little bit about this?
Wow, what a great day that was! Gosh, thank you for reminding me. Yes. The crazy gang, right? I was telling my daughter about this. She's into a lot of sports herself, plays a lot of cricket and hockey herself, and I was telling my daughter about the crazy gang. She's 14 in a couple of days, and I was saying the thing about them, what I'd always admired right from the start, was it didn't matter what one's individual background or history or tradition was. They didn't care whether, if you've got the history or the heritage of Man United or Liverpool or Chelsea, they're still going to take the fight to you. And I was always impressed by that, So that was one great day for the crazy gang, I must admit. Although there was a game it was.
Yes, let's move on. Yeah.
Well, if it wasn't for Gerrard, we would have done another episode anyway, another time.
Indeed. By the way, that team is Wimbledon for anyone who doesn't know. And the only thing I do remember that sticks in my mind, apart from the obvious things, my dad put on a £2 bet for Liverpool to lose because he thought that the 4-1 £8 upside would somewhat comfort the blow. All I can say is it didn't. Right. Anyway, let's move on. One thing I would say, Moorad is the author of the Principles of Banking book, over 900 pages of the best knowledge in the industry. For all our guests today, we're going to run a ballot at the end of this session, and you'll see the book there. And if you put yes in the comment section, we'll know that we can opt you in, and we're going to run a ballot, and the winner will get that book, and it basically tells you everything you possibly need to know about liquidity risk in the banking industry. So thank you for that, Moorad. Now, moving on to the topic today, mastering liquidity risk. We're going to take this in 3 sections. First one is your experience, Moorad, on lessons learned from the past, what it means for today's liquidity risk management. Part 2 around culture, so risk culture. I'd really like to explore that in terms of what role that plays. And then finally, the future of liquidity risk management that you say in your view. So starting with part 1, lessons learned. Clearly, the way we operate today has changed dramatically from the year 20, 25 years ago. The role of the treasurer, the C-suite. Great to get your views on what's changed over years and what we've learned.
Absolutely. Happy to opine. I should always stress that they're always my personal opinions. Finance and banking being what it is, it's more art than science, or as much art as science. It's not physics, so there's always more than one right solution. But the heart of the matter is, today, after last year's failures, what you just asked about, lessons learned. And at the end, you just asked, how has the role changed? Certainly from my day in the money markets, UK sterling money markets in the early to the mid 90s, it's changed a lot. But at the same time, or almost paradoxically, the core role of the Treasury function is unchanged, and not just from the early 90s, but from the 1890s or the 1790s, insofar as the traditional principles of liquidity risk management, banking risk management, including liquidity and asset liability management, are unchanged. And that leads me to your first question, which is, what are the lessons learned? One would have hoped that lessons learned from the 2007 to 2009 bank crash would have been learnt, and by and large they were. And in many cases, the lessons, even if they weren't learnt, have been forced on us because of regulatory guidance post 2008 bank crash. As we've all observed, is much more onerous and prescriptive than it was in my day in the money markets, 30 years ago, 35 years ago. It's much more onerous and prescriptive. So even if one hadn't learnt the lessons, then with regard to things like liquidity coverage ratio or rules on intraday liquidity, they are more onerous than they were. So even if one hadn't learned the lessons, one has to follow regulatory rules. But it would appear that that's still not enough. And I've always thought that it's not sufficient just to follow what the regulator asks you to do. One has to apply one's own common sense and good judgment. The lesson learned from 2023, if we just keep aside one aspect of it, which is the speed of transmission, what I'm calling social media risk and the speed of transmission, we'll come back to that. If we leave that aside, that was an old-fashioned mistake that those 3 or 4 failed banks from last year in the US made. They got the liquidity risk wrong. They didn't address what today we call Pillar 2 liquidity here in the UK, but it's not a new type of risk. What are the constituents or the segments of Pillar 2 liquidity? Concentration risk, whether that's concentration by type of product, type of customer, or the concentration within one part of the yield curve, the term structure, or all three. Whether it's managing what they call the franchise liquidity risk, the rollover funding, all these things, they're not new risks. They would have been something that we would have been managing in the 90s, or I said the 1890s, and after 2008, I would have hoped that everyone learnt them. The failures of last year were essentially because of everyone talks about interest rate risk. Yes, interest rate risk rises by the Fed, I would suggest, with a catalyst that exposed a flawed funding model. They had very excessive concentration of liquidity, concentration by type of customer. In the case of Silicon Valley Bank, very excessive particular type of customer, non-bank FIs. If you want to point to one type of customer whose deposit base would be markedly unstable in a stress, it's a non-bank financial institution. That was a large part of their customers. They had a large part of their funding base was instant access, whether it's operational deposits, MTAs, or instant access, savings accounts. So there was excessive concentration, and that was exposed once rate rises exposed their unrealized mark-to-market losses. Now, you might think, well, that's new, isn't it? Well, not at all. If you cast our minds back 40 years to the savings and loan industry in the US, they had a similar funding model. They were lending very long-dated fixed rate and funding in the overnight. And that was exposed, all good and well and good, until the Fed started raising rates in a much more aggressive way than I think they did in the last 2 years. If you look at the 1980s, the Volcker regime, that was a much more aggressive rate rise scenario. And so it's not new. So the lessons learned were, we haven't learned about concentration risk and liquidity. Well, certain banks haven't. We haven't learned about the importance of the ALCO, the Asset Liability Committee, and ensuring that the balance sheet shape and structure is sufficiently robust. And that, to me, is I'm dismayed to observe that, because we shouldn't forget lessons from the past. And there's no reason for us to. Even if one is a newcomer in the marketplace, one can learn from history. So that, to me, is my takeaway from last year. Now, we can get on to what I called social media risk and the speed of transmission, but it doesn't undo the fact that the core principles of managing liquidity should be learnt and adhered to and are unchanged for the last 500 years. I'm reading. I will stop now for a second. I'm reading.
I was going to say 500 years. We're not quite that old.
No,
but...
no, absolutely. But the thing is, I'm reading a really interesting book, and maybe I should get out more. But there's a really interesting text about the history of the Bank of Scotland and the Royal Bank of Scotland. The Bank of Scotland was the first bank in recorded history that introduced the concept of a notice deposit account. This is in the early 18th century. So we're talking very early 1700s. Why did they do that? Because they realized that all their deposits were instant access. If all their customers came into their Edinburgh branch on one day and said, we want our money, they're out. They're bust. So they introduced a 7-day and a 30-day notice deposit. In other words, they're terming out their funding structure. They've realized that they've got concentration in one product. So if that's something someone can do in the early 1700s, here we are 300 years later. Why are we having to relearn that lesson? So that was my point about, there's a lot of old lessons that need to be relearned and adhered to if we're going to stay safe. I mean, I would be happy to see no bank go bust. Whether it's systemically important or not systemically important, there's no reason for a bank to fall over because it's got its ALM discipline wrong. None whatsoever.
Now, what I found interesting, I only came into this industry in about 2013. I had a history in tech, so it wasn't in this industry. And what I found then, I could not believe this industry in terms of not knowing where the cash was, where the liquidity was, nothing about real time. Even intraday, it was maybe in a few weeks' time, I've got an Excel spreadsheet. And, fast forward to the 2023, some conversations we were having with those banks, they were pretty much the same. It was spreadsheet driven. It's as if they didn't really care about it. So I was amazed that we still have those conversations today. It was only social media that was the change that took everyone by surprise from the speed.
I mean, the reason I'm smiling isn't because what you're saying is amusing. It's actually quite sad, but you're spot on. And now the reason I then smiled a bit more because you mentioned about everyone's on Excel spreadsheets. I got to Horgavet Securities in 1992, and I was saying to everyone, "Are we still on Excel here?" That's in 1992. Do you not have a core platform that does this? Fast forward 35 odd years, or 30 odd years, and very common. We're still on Excel. Now, there would have been a time, we're talking about 300 years of history, there would have been a time over the last 40 odd years when the analytics capability to be on top of balance sheet data, you mentioned real-time data, you mentioned even leave intraday liquidity. What about real-time, just my balance sheet position, closing business yesterday, what does it look like, how's it changing, can I stress test can I do a scenario based on today's balance sheet, just if interest rates change, or just if this type of product is cut down in volume, something like that. Now, 10, 20, 30 years ago, there's an excuse for banks, if not all of them, large numbers of them, to not be on top of that because the analytics capability wasn't there. But today, in 2024, I would suggest for most banks, if not all, it's achievable. It's not a fantastically challenging state of affairs to be in, whereby one can get the data analytics capability in place so that the knowledge of the balance sheet is more real and up to date and accurate, okay, rather than just waiting for the Excel spreadsheet next day or something. There's no reason not to be on top of that. And as you and I all know, as everybody knows, certain banks are more on top of that than others. But today I would suggest it's much more accessible. The technology is much more accessible. So there's less of an excuse to not be on top of that knowledge.
That's right. Right, Moorad, just before we ask the next question, we have one from the audience, Dan Theony. Shouldn't the central banks have some responsibility for banks' poor cash visibility as a primary issuer of currency?
What a great question. Now, interestingly enough, at the time of SVB and First Republic last year, I was seeing some chat on social media, LinkedIn, it's the only one I do, and some commentators were saying, oh, well, it's the Federal Reserve's fault. By the way, I'm not saying your questioner is saying that. And your question was asked about liquidity, not rates. Yeah. But I just want to give my caveat, which was some people were saying, oh, well, it's the Fed. They raised rates, so the bank got into trouble. I mean, the job of a central bank is to change interest rates. I mean, they don't stay static. They might have stayed zero for a very long time, but that's what central banks do. They change rates up or down, and that's what they do. Traffic lights change from red to green and back again. It's what they do. Yeah. Now, your correspondent has said Do central banks bear some responsibility? My personal opinion is no, because ultimately the responsibility and accountability is for the bank itself. Central banks bear an element of responsibility, a great deal of
Yeah.
responsibility for systemic soundness. They bear responsibility to ensure that the whole system, the whole industry, the whole sector is sound, such that the economy doesn't suffer. But at the individual bank level, it is the responsibility of the board and particularly of the asset liability committee to be on top of liquidity risk management. So I would have to suggest, in my personal humble opinion, I don't think it's the fault or responsibility of a central bank or the supervision authority to be responsible for any individual bank's liquidity risk exposure or planning or management. They supervise it, certainly. That's why we have SREPs, and that's why we have periodic summary meetings and monthly calls, and that's why we have regulatory reporting. That's what they're responsible for. But they're ultimately not the responsible authority and the accountable authority for the individual bank. That has to be with the bank. I think it's a sorry state of affairs if we start to absolve ourselves as senior execs to say, oh, hold on, it's the supervisor. They didn't tell us to do this, which gets me onto another favorite topic of mine. I said at the start, we don't just do what we're obliged to do. We need to apply our own judgment to manage the balance sheet. And if that means doing a bit more than what the regulator requires, we should do it.
Yeah, exactly.
Lots of commented chat about how the fact that Basel III guidance only applies to banks in the US that are above 250 balance sheet. Now, SVB was around $210 billion. Now, that might be below that cutoff, but by any stretch of the imagination, by any definition, that's a big bank. Whether you're in the US or you're in the smallest economy in the world or the largest, $200 billion or sterling or euros of balance sheet is a big bank. It might be in your own interest to do a little bit more than what the regulator requires.
No, I agree. Now, Moorad, you mentioned non-bank financial institutions on a previous podcast. One of the guests, they opined that the next failure is going to be a non-bank financial institution. It's probably not going to be a bank, and I've heard that quite a few times. Is that something you think is the right? Because banks are regulated more heavily, and NBFIs maybe not as much. Is that your opinion as well?
Well, we did see how, actually, we've been here before, haven't we, with long-term capital management in 1998. That's last century. That's how long ago it was. We have been here before where a non-regulated, non-bank FI, because of its interconnectedness with the regulated sector, if it gets to a certain size and the depth of its connections, if it fails, it could have a knock-on effect that's serious, which is why it was bailed out. LTCM was bailed out. We have been here before, and the short answer to your question is it's an area of concern, absolutely. Why does the non-bank, non-regulated, people call it shadow banking as well, why does that grow in size? One of the reasons is, paradoxically, because of excess regulation in the regulated sector drives some business to the non-regulated sector. That's just normal response in capitalist free markets. But of course, if I was in the regulatory authority space, I would have a concern when you get certain size of institutions with their connection with the rest of the marketplace. If a failure there where I have no authority to supervise, I would be concerned. Look at how with Credit Suisse, it wasn't the nail. It was maybe perhaps a nail in the coffin, but Credit Suisse ultimately came undone because of a whole history and a catalogue of bad practice. But look how the Archegos hedge fund impacted their capital position. Now, just imagine if you have a very large non-bank FI connected to globally systemically important banks and they fail. It's a concern, absolutely. I wouldn't want to predict that the next failure might be a non-regulated bank, or FI as opposed to a regulated bank, but obviously a failure of a large enough institution in the non-regulated sector is a concern. But the paradoxically, why does that sector grow? Because of excess, or I don't want to use the word excess, but because of the level of supervision in the regulated sector. Now, if we are concerned about the growth of that sector, one either passes legislation to bring it into regulation or looks at the level of regulation in the regulated sector to try and redress some of that balance. On a separate podcast one day, maybe we can explore that topic.
No, I get it. But, we're pressing down over here, risk will appear over there.
Absolutely, yes, exactly right.
Okay, great. Just for our audience today, if you want a chance to win Moorad's book, The Principle of Banking, just put yes in the comment section and we'll do a ballot at the end of this podcast. Now, I've heard a lot of comments, Moorad, about it's just about capital. You have more and it's high quality. You're absolutely fine. It plays an important role, but it can't just be that. That can't be the only answer, just having more capital.
No, I mean, regulatory authorities, that's a good point you raise. Regulatory authorities have ultimately they have quite blunt instruments at their disposal when it comes to supervising banks. They can raise the capital buffer, they can raise the liquidity buffer, assets. So either side of the balance sheet, liabilities and assets, or they can, they can levy fines, or they can ask you to do independent expert reviews. Here in the UK, we call them Section 166s. But really, their tools are quite blunt instruments. It's not just about it can never be just about sufficient capital and sufficient liquidity. Remember, there's two sides of this equation. A robust balance sheet isn't just one that has lots of capital liquidity. It also has to make P&L. The shareholder wants it to return its target rate of return. That's why the role of the asset liability committee, the ALCO, is so important, because they're right down the middle. They're right down the middle of the the risk side, making sure we've got sufficient capital liquidity, and they're right down the middle on the P&L side, make sure we're generating sufficient P&L to return our target rates of return. It wouldn't be sufficient to maintain long-term viability simply to be looking at the capital base, which ultimately is your liabilities base, it's your funding structure. If we want to go down the route of the development banks, which are usually sovereign owned, well, actually, I think they're all sovereign owned. I'm not sure I know of a private sector development bank, but if we look at those, they have if I'm generalizing here, but they have a 50% equity funding base and a 50% very long dated 10, 20, 30 year bond funding base. That's viable for them because they have different objectives. A commercial sector, privately owned, shareholder owned banking institution couldn't have, it would struggle. It would struggle to make return on capital if it had that funding structure. It's not just the capital base, and it's not just the level of liquidity reserve. It's also about having a business model that enables you to keep generating the sufficient target rate of return. There's the challenge for the ALCO, you see, which is why it's the most important committee in any bank.
Yeah, and just some comments there from James Bernstein. Capital is a skeleton of bank. Liquidity is the lifeblood. Capital does not protect liquidity risk. Absolutely.
100%. I couldn't. Did you just? Was your correspondent's name's James Bernstein? Was that? Did you just say that?
Yeah.
Yes. I've not met, but he always says some very nice things about my comments. So I just want to thank you personally, sir. Well,
there you go, James.
Not personally, but via this webcast. Thank you for your kind words. Please keep the comments up.
Let's move on to risk culture, because I hear a lot about this, which is and a very important role is the culture of the risk that the bank has, how they manage it, how they push it through the organization. And what this brought home to me, I was at a conference. It was an open conference about a year ago. It was after what happened. And I met a chairman of a large bank who'd bought another large bank, and their commentary on the other bank was that everyone there, they were like pigs in a pigsty. They were just filling their boots. The risk was all over the place. There was no management, no control. But it was open forum. It wasn't even private. And so it must have been bad. But I hear it's bad everywhere. I mean,
it must have been bad. I mean, I might hazard a guess as to what firms you're talking about there, but that's
not mentioning any names or anything.
No, I'm not mentioning any names either. I'm unsurprised to hear that. Now, risk culture, which only for good reasons, it's in the last year or two, it's becoming more and more talked about, and I don't mean in that tick box bureaucratic way, which one is obliged. It's a topic that's hard to talk about in a practically valuable way. I'm going to make an analogy. I've lost count of the number of banks who will say to me, "We put the customer first." The customer is the heart of everything we do. It's lots of banks say that, but not every bank actually does it. It's the same sort of platitude when one speaks of risk culture. Oh, we take risk seriously. The opinion of everyone is sought. It's very easy to say these things. The reason risk culture is very important, but it's one of the hardest topics to practically tie down, is because it's easy to say. We can write about it. We can have a PowerPoint slide or a book. Indeed, there's a chapter in my book that you very kindly just mentioned on ethics and good conduct. It's very easy to write that. The difficult thing, the challenge, is to actually do it. Now, this anecdote that you shared with us about a bank senior executive mentioned another bank. That bank wouldn't publicly have said that. They wouldn't have said publicly, "We've all got, we're all like pigs with our nose in the trough." They would have had well-defined risk management frameworks. They would have had a whole range of policy documents and process manuals about effectively managing risk. They would have had risk limits for every key risk indicator in place. This is my point about risk culture. We are obliged as regulated institutions to have formal risk management frameworks. We have a risk management framework. We have a risk appetite framework. We have key risk indicators assigned for every type of risk exposure that the bank has identified as on its risk register. And yet, that's not enough, is it? We have lots of regulation. We have prescriptive regulation. We have first line, second line, third line. We have third line. We have internal audit reviews. We have external audit reviews. We have regular supervision visits. But if one looks at Credit Suisse, for example, they were a globally systemically important bank. They didn't just have one regulator. Even though they're not in the eurozone, their domicile is not the eurozone. They had ECB supervision because they were so significant in the eurozone, in the European Union. It's not sufficient, though, is it? Because if the culture's wrong, then you're going to crash on the rocks. Now, what do I mean by that? I'm going to reiterate it. What I mean is, it's when you don't actually do in practice what you say you do in your risk management framework. I've got another example. I don't want to name this bank, but this is a GSIFI bank just outside the EU, actually. This is a GSIFI bank, and I read a story in the Times, so it's not in the business newspaper, how their their market-making business for ETFs it blew up in terms of P&L, and it was found to be more than twice over its limit. I'm wondering, at what point does no one say anything? When I'm 5% over a limit, a risk exposure limit, someone should say something to me, right? If I'm 50%, I should be out the door. If I'm more than 100% over, why has nothing happened? So they had a limit framework in place. They just weren't following it. This is risk culture. Risk culture, people talk about ethics doing the right thing when no one is looking. My definition of risk culture, actually doing what you tell everybody you're doing. And if you get that wrong, the worst case, absolute worst case, is when you have a Credit Suisse. You become unviable and you're forced taken over. The risk culture is very important.
No, it is.
Go on, sir.
And I'll tell you what I do here a lot is the excuse of, well, I didn't have the insight, the data, the management information. It wasn't there, so I couldn't make a decision. That has changed a lot. Technology has moved on. That's what we do as our business. But I hear a lot of that. And is it an excuse or is it true? I think in some areas it is true. But come on, we've moved on a lot from that, haven't we?
I mean, it may well be true, but I would suggest it's not sufficient an excuse. At the end of the day, decision making is what we're here to do. Whether one is a member of the board or a member of the ALCO or simply a senior manager in any department, decision making is what one is paid to do. Simply to point out a lack of data to make a decision, I would suggest today is not sufficient. But let's just take that observation as given and say, yes, you don't have sufficient data. What are you doing to fix that problem? What are you doing to fix the fact that you don't have data enabling you to make a decision? Surely it should be a number one priority if it's stopping you from making decisions, you see? So that I would suggest in 2024, that's an insufficiently acceptable excuse not to make a decision. If it turns out to be the wrong decision, look, which one of us hasn't made wrong decisions in our lives? Happens all the time. We learn from our mistake and we move on. But I would suggest it's not sufficient today to point to a lack of data. If the data capability or the analytics to understand the current shape of the current level of exposure or the current shape of the balance sheet and what it means in terms of sensitivity to external factors, if that's not there, it should be a high priority to get it in place. Ultimately, what's the role of an ALCO? I mean, what's its objective, really? It's to provide comfort to the board that the balance sheet is in good condition. And the key part of that is, do I understand the sensitivity of the balance sheet for capital, liquidity, and P&L to changes in external factors? External factors that are outside of my control, like interest rates or FX rates, or rise in unemployment resulting in greater levels of default, customer default. I need to understand the sensitivity of the balance sheet to those factors and understand it such that I can take action to mitigate any negative impact. That's the role of the ALCO. If the data isn't there to enable you to do that or understand that, what are we doing to get on top of that? Because that's our objective as the ALCO.
Great. Now, look, we are running out. Unfortunately, the half an hour is almost gone, Moorad. But the
That's
one question I always ask, as long as it's not pleased by my book, what's the one takeaway bit of advice that you'd give to the audience? And if you could talk about the future, what would you see in terms of the future, what you should think through? But one piece, your top piece of advice.
Okay, I'm not allowed to say buy my book, but I wouldn't have said that anyway, Neville. That's for you to say.
Exactly. I would buy the book, though. You have bought the book.
You have bought the book. Now, the top piece of advice is this. Look at, I'm assuming this is going to a practitioner in a bank, in a banking, so a regulated entity. The top piece of advice is look at the delegated authority and the power of your ALCO to actually manage the balance sheet. In other words, they have sufficient seniority so they can keep the board informed, maintain comfort with the board, warn the board of anything, because the board ultimately has responsibility. What is the role and the power and the authority and the seniority of your ALCO. If it is what you consider sufficient, then great. If not, let's change it. Within that same piece of advice, is it a genuinely value-added conversation at the ALCO? Does the chair invite debate from everyone, get the opinions of everyone? Are all relevant stakeholders represented at the ALCO? The business line heads, the C-suite, CFO, CRO, CEO, internal audit rep, is all the relevant stakeholders there at the ALCO? Does it have the authority to actually manage the balance sheet so it can make sure the balance sheet is in safe condition? That's my one piece of advice. The role of that committee has never been so important and is more and more being recognised today, after 2 decades worth of bank failure, 2008, 2023, than today. And now is time for us to learn our lessons and get the balance sheet governance framework in the right way, in the right mold, get it in the right level of authority. That is the one piece of advice I'd give. What is the role of your ALCO?
Perfect. Thanks for that. Unfortunately, Moorad, we have run out of time. There's quite a few questions come in. We're going to collect them and answer them afterwards. But thank you for all your questions today. And one of the reasons that we work with Moorad so much ourselves is because you can probably tell from the last half an hour, there's just this great knowledge, best practice. It's all in the book as well, but I would encourage you to reach out. No, it's
very kind. Thank you.
It's fantastic. We will answer those questions after the event. Unfortunately, that concludes our latest Liquidity Talks live stream and podcast. We'll put the podcast on LinkedIn, Spotify, Apple Music, and other media outlets and streaming services very soon. Thank you very much, everyone, for joining. Look out for our next podcast coming next month. My name is Neville Roberts. Thank you for tuning in, and goodbye.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of treasury, liquidity and risk.